Hello and welcome to this session in which we will discuss the AICPA rules for independence. Every time you hear the word AICPA, it means we are dealing with private companies, private issuers, non-public companies, because we're going to have another sets of rules very similar to the AICPA dealing with the PCAOB. Independence is very important in audit, whether you are dealing with a private or a public company, issuer or non-issuer. The worth of any audit opinion hinges on the public perception about the independence of the auditor. Now, why? Why is that important? Why is independence the cornerstone of audit or any attestation service? Well, because in an attestation service, for example, an audit, we have three parties: the CPA, the company that we're auditing, and the users of financial statements. So we have three groups: 1, 2, 3. Now, who hires the CPA? Well, the company. Well, technically the audit committee, but the company pays the CPA to issue an opinion about the financial statements. Now, this opinion is used by the users of financial statements who are a third party. So simply put, the CPA, which is party number 1, is providing opinion to party number 3, who are the users of financial statements. Therefore, if the users of financial statement don't believe the CPA is an independent of the company itself, then their opinion is not worth much. Therefore, the perception of independence is extremely important. They have to be perceived also in fact and in perception, both. They have to be independent. Matter of fact, there are two components of independence. Independence of mind, which is also referred to as in fact, which is indeed actually you are independent in mind. Also independent in appearance, which is the perception that you are independent. What it looks like is important. It's not only that you are indeed independent in mind, but also you act as if you are independent in appearance. In other words, you cannot be seen as advocating for the client in any way, shape, or form. Now, the first thing we're going to look at is who are the covered member under the rules for independence. We'll start with that. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Who is a covered member? So those independent rules, who do they apply to? Well, covered members is any person who's in any position to influence an attest engagement. For simplicity, we're going to assume what we're talking about is audit, because attest engagement we could have other than audit, but audit we commonly know what an audit is. So any person that is in a position to influence the decisions about the audit outcome is a covered member. Let's look at them. Well, the first are the people who are actually working on the audit themselves, individual involved in the attest engagement. Well, those are the frontline people, including staff, senior staff, managers, so on and so forth. Individuals with the capacity to influence the engagement itself. Who are we talking about here? The supervisors, the directors, the partners that are in charge of this assignment. Also, partners or managers offering 10 hours non-attest services to the client within that fiscal year. Non-attest is what? Basically tax, consultant. Even if you are providing those services, you become a covered member. Then you have to be independent. Partners who are within the office of the partner overseeing the attest engagement. Just by being in that office, you become a covered member. You have to be independent. The company, it means the firm and the associated employee benefit plan, they have to be independent. Any entity subject to control by any of the members, covered members. So if you're a partner and you own another corporation or a partnership, that party becomes a covered member. Now we're going to be discussing the most common circumstances where independence might be jeopardized. And we're going to look at those, and we're going to discuss each one separately. Sometimes it could be jeopardized by financial interests or related financial interest issues such as loans, consulting, bookkeeping, and other non-attest services, employment relation, litigation between the CPA firm and the client, and sometimes you could have unpaid fees. So all these situations could impair independence, so we need to know the rules. Starting with financial interests. The code you cannot prohibit covered members, simply put, the people who are working on the attest engagement, to have any direct financial interest. It means what? You cannot own stocks in the company or direct investment in that company, regardless of how much is that investment, whether that investment is $1 or $1 million. When it comes to direct, that's it, you can't. So simply put, let me just give you an extreme example. You happen to be working for PwC and they are auditing Apple computers. Well, you cannot own 1 share of Apple computers, not even 1 share. Okay? Why? Because you cannot have, that's a direct financial interest. Therefore, you can't have that share. You have to sell it. You are a covered member. Now, immediate families, also covered members. Who are the immediate families? The spouse and the dependents of that individual. Those, they cannot also own direct financial interests. They cannot have stocks in that company. Then we have an indirect financial interest. What is indirect financial interest? It's characterized by ownership that's close in nature but not directly held. A prime example is a mutual fund. What is a mutual fund? A mutual fund is basically a portfolio of stocks that you could have Apple in it, Microsoft, Google. You could have a bunch of stocks in that mutual fund. Now, you don't own any of the stocks. You own the whole mutual fund. You own the mutual fund itself, part of that mutual fund, and you don't make that decision whether they select Apple or they select Microsoft or whatever. Well, if that's the case, if you have indirect relationship, now materiality matters. How much do you own in that fund relative to your wealth will determine whether your independence is jeopardized or not. So we would look at the individual wealth and income are taken into account. How so? Let's assume you have $10,000 in that fund and your total wealth is $100,000. Well, that's 10% of your wealth. That's a substantial amount of your wealth. Or you own $10,000 in that mutual fund and your total wealth is $1 million. Well, that's not a substantial amount. It's not material. So when it comes to indirect financial interest, owning stock through a mutual fund, now it depends on materiality. However, any direct financial interest is prohibited to you as well as your immediate families, which are spouse and dependents. How about the financial interests of close relatives? Now, we need to know who are the close relatives. Close relatives are defined as parent, sibling, your parents, your brother, sister, or non-dependent child who are, they're not living under your roof, non-dependent. Well, what happens if they own stocks in that company? Well, the first thing you need to ask yourself, are you aware of their ownership? If you're not aware of their ownership, it's like water under the bridge. Or you have a reason to be aware of it. What does it mean you have a reason to be aware of it? Let's assume your parents work for, GE, General Electric, for 20 years. And now you are auditing GE. Most likely, your parents, since they worked there 20 years, most likely there's a good chance that they might own some stocks in GE. Why? Because GE might have employee stock purchase plan where employees were able to deduct money from their paycheck to buy the stock. Maybe they have stocks in their retirement plan. So do you have a reason to be that your parents own the stock? Okay. Ownership by close relative is not an independence breach unless the amount is material. So here also materiality matters, or let's assume your parents work at GE for 20 years and now they are on the board of directors. Now they are making decisions, significant influence. They have significant influence because on the board of directors they can influence the company. Well, then it is an issue. So the amount has to be material. First, you have to know or have a reason to know about it. If that's the case, you look at the amount. If the amount is not material, it's not a big deal. Or if they have a significant influence. For example, the parents are board members. Well, that's a problem. Now, immaterial interest does not impair your independence. So if your close relatives own some stocks, you're still in good shape. You don't have to leave the engagement. How about financial interest in terms of loans? Well, let's look at financial interest. Generally speaking, financial relationship is prohibited in any way, shape, or form. Now, what happens if you are auditing a financial institution or credit union? Well, basically, any loans outside normal lending procedures is violation. So if they gave you a loan because they want to favor you somehow, they're not following the regular underwriting procedures, then that's prohibited. However, if the loan that they gave you is fully collateralized, for example, you have a home against that loan, it's fully collateralized. They're not giving you any favor. If you don't pay, they will take your loan. Car loan, if the car is collateralized in the normal course of business, that's fine. That's fine. Also, if you have a credit card debt with that institution less than $10,000, you don't impair your independence. Also, if you have a deposit below the federal deposit insurance company requirement, that's fine. And for now, the amount is $250. Also, no new loan is preferable. So they basically, if you are auditing a financial institution, just wait if you don't get a new loan from them during the engagement, the attest engagement. It's not preferable to do so. Joint closely held investment with client. What does that mean? Well, let's assume the CPA firm owns stocks in company A. So we have company A here, and the CPA firm owns stocks in company A. Now, also, company B, now we have a company B, and a company B also owns stocks in company A. Now, the CPA is also auditing company B. So do you see how they both, company B and the CPA firm, they both own company A. Is there a violation of independence? It all depends on the amount. Let's assume company B owns 1%, the CPA firm owns 1%, and 98% is owned by someone else. Well, it's not a big deal. Let's change the scenario. Company B owned 30%, company B owned 30%, the CPA firm owned 30% of that company, and the remainder is owned by 40%. Now, the CPA firm plus the company B, which is their audit client, owns the majority. There's an independence issue here. So it depends on the materiality. How about employment of close relatives? Well, employment of immediate and close relative members could be a problem if the covered member have an immediate family member in a key position with the client. And let's double underline key position. Key position means what? It means that individual, your spouse or your close family members, they have a saying in the preparation of the financial statement. They make significant accounting estimate. That's part of the financial statements. Have the ability to influence in one way or another the outcome of the financial statements. If that's the case, well, you lose your independence. But let's assume they do landscaping work for the company, they're in janitorial services, customer service, support work. That's fine. I'm just giving those extreme examples so you can see the point. If they have no relationship to the financial statements, then you should be in good shape. So for example, if they're a CFO, then you're not in good shape. Your independence is impaired as an auditor. Other situation, the covered member cannot be board member, officer, or director of an audit client. That should be kind of a common sense. You cannot be an underwriter, promoter, or act in any capacity of management or be an employee of the company. Also, it's common sense, but we have to basically mention it. You cannot be in any capacity of management. That's a no-no. How about if a former partner, member of the audit team, get hired in key position with the client? Well, what we have to do is this. Generally speaking, that would impair our independence unless we change strategy, modify audit procedures. Why? Because this individual that left the audit team and now working for the client would know the strategies that we are employing to audit this client. The mere fact of discussing employment or receiving an unemployment offer could impair independence. So what needs to be done, that individual will need to disclose this and will need to be removed from the engagement immediately. Now, honorary director for not-for-profit like charity or religious organization is okay. Like I know where I used to work, my boss, the partner that I worked under, Bruce Palmer, he was an honorary director on many not-for-profit organizations that I did the audit for. Honorary director, that's okay. Let's talk about non-attest services, consulting, bookkeeping work. You cannot perform managerial or other significant role during the attestation. That's prohibited. Can you install accounting information system? Yes. Installation, you're helping them install like technical, yes. Can you have any saying about the design of the accounting information system? No. Remember, the design of the accounting information system, which is part of their internal control, is the responsibility of management. So you cannot make a managerial decision. Therefore, you cannot make decision about the design. CPA must be assured that the client is willing and able to perform function related to the engagement, managerial function, to be specific, not any function, managerial function. That understanding is necessary because the auditor don't run the company. It's the company. It's management that runs the company. Management prepare the financial statements. And that need to be clear that management can and willing to do that. You can perform basic bookkeeping and journal entries, of course, under the authorization of the company. So the company must authorize the transaction. So you are performing the work, but they're telling you what to do. So you're not really making the decision. You gotta be careful here because self-review threat could be present under the circumstances. What's self-review threat? Self-review threat is one of these threats that we talked about that could compromise your independence, that could compromise your objectivity, is when you are reviewing your own work. So when you do the bookkeeping work, well, you are auditing yourself. You can help with internal control as long as management maintain responsibility for directions and oversight of the internal control. How about litigation between the CPA firm and the client? Well, the commencement of litigation by management claiming deficiency in the audit work, well, that could impair independence. Also, an express intention to commence litigation when the CPA believe it's probable the client will commence litigation. Whether you started or they started, that could impair independence. The commencement litigation by CPA against management alleging fraud and deceit, that also could impair independence. How about unpaid fees? Because when you have an unpaid fees, simply now you have a financial relationship with them. Billed or unbilled fees remain unpaid more than 1 year before the date of the report, technically becomes a loan. And what does that mean? You become a financial institution. That becomes a violation. So what does that mean? Let's assume this is year X6 and you're auditing year X6 and you're going to issue the report, I don't know, March 1st, year X7. So you have to look back 1 year, okay? Billed or unbilled fees unpaid provided more than 1 year. So if they owe you any money here, then it becomes technically a loan. It's a violation of independence. Now, if the company in bankruptcy and they're not paying their fees, that's okay. They're in bankruptcy. Let's take a look at this multiple choice questions from Farhat lectures. Which of the following situation is an example of an indirect interest in a client? Well, let's take a look at D first. The covered member, that covered member subject to the independence rule, is a general partner in a partnership that holds shares of stock in the client. So we have a partnership somewhere, a business, and the covered member it's a general partner, and that partnership owns stocks in the client that we are auditing. Is this a direct relationship? And the answer is yes. This is a direct financial interest because the partnership owns stocks in the client, and the general partner is an owner of the partnership. The covered member is the owner in the partnership. Therefore, D is not the answer because this is a direct financial interest. Let's look at C. A partner in the office in which the audit is conducted but who does not participate in the audit owns 5% of the client's stock. Well, they own 5%. That's a direct financial interest. And it's not only that. The partner is in the office which the audit is conducted. So just by being in the office, you are a covered member, let alone you own 5% of the client's stock. Definitely that's a direct financial interest. So we're down to 50-50. The covered member's wife owns 5% of the client's stock. Now, the wife owns 5%. Well, that's immediate family. Immediate family cannot have direct financial interest. This is a direct financial interest. By process of elimination, the answer is A, but we always want to double check. The covered member owns shares in a mutual fund that holds shares in the stock of the client. Yes, that's an example of an indirect financial interest. Is that prohibited or not? Well, the answer is it all depends on the materiality. How do we measure the materiality? We looked at the covered member income and wealth, and we'd look at their investment in that fund, in that mutual fund, relative to their total wealth or total income. So this is an indirect relationship because owning a mutual fund that owns stocks in that company is owning stocks indirectly in the company. And that's what we mean by indirect financial interest. Remember, direct financial interest always prohibited for covered member. Indirect one, well, it all depends on materiality. What should you do now? Go to Farhat lectures, look at additional MCQs, true, false, additional exercises that's going to help you do what? Learn the topics better, whether you are a CPA exam candidate or an accounting student. Good luck, study hard, invest in yourself, and stay safe.